sorry. This is Muhammad Akram. I'm here to moderate the webinar, How to Raise Capital in a Volatile Market. I'm the founder of Akram Insurance Advisory and Tax Firm. We provide accounting, audit, and tax services to hedge funds, private equity, venture capital. I will ask my other participants to make an intro. Nicole, would you tell us about your company and your role?
Sure. Thank you for having me today. I'm Nicole Belmont. I'm the Director of Research for Far Hills Group. So Far Hills Group is a placement agent. We're focused on raising capital for alternative investment managers from institutional investors. So we work with hedge funds, venture funds, private equity, private credit, CTAs. We're based in New York City, but it's a global practice. So each year, about half the assets we raise are from investors within North America, the other half from outside. And over the last 30 plus years, we've raised over 28 billion in assets. And in my role as Director of Research, I'm responsible for sourcing new managers and the initial diligence that we do on those managers. And then once we're working with a fund, anything behind the sales.
Awesome, thank you. Jeff?
Sure. Hi, my name is Jeff Shon. I am fund manager for Reds Capital, and we are very much an emerging or first-time fund ourselves. We operate in the early stage VC space. We've got representation across North America and Israel, and our portfolio largely mirrors that geographic distribution.
Okay, awesome, thank you. Steve, would you like to tell about yourself? Steve Kahn. Steve, are you there?
I'll take over, he seems to be frozen. This is Steve Rosen. I work at Akram Associates with Muhammad. We have a 20+ year working relationship. I sit on the audit side of things and have spent most of my career doing audits and tax work of smaller and emerging managers.
Okay, awesome, Steve. Thank you. Hopefully, Steve will join us soon. But Steve, would you like to start moderating this webinar? Please go ahead.
All right. So we're all here because obviously, being an emerging manager or working in the field has its own inherent pitfalls and hard times, and the biggest one being capital, sourcing, funding. How do you get it? Where do you get it? What's the best way to do it? So everybody has obviously their own network. Everybody has their own pipeline of people. I would just throw out quickly to Jeff, what have you found to be the most successful way to build a pipeline of potential investors for you?
So as an emerging manager, you need to cast your net as widely as possible. You need to exhaust your family and friends network, any sort of business associates that you have, because your close rate is not going to be great. Everybody that invests with you is going to be testing you out. And there is going to be some obvious hesitation with a first-time manager. So in that respect, without a track record, what you need to focus on is your deal flow, any sort of past accomplishments that you have, and any sort of unique spin on sort of what you do in your space and really what sets you apart. Certain tried and true methods like, networking, attending conferences, speaking engagements are all helpful. But, ultimately, you just need to speak with as many people as possible.
Jeff, thank you. Which will roll me into my next question for Nicole, or my next subject. So that piggybacking off of what Jeff said, there are many ways to structure the capital. As Jeff mentioned, friends and family and other venues or avenues. What would you suggest in terms of what street to go down, depending upon how big or small you might be on your initial launch?
Sure, I totally agree with Jeff. It's cast a wide net, but also know your audience. So there's a natural progression of who you're going to go market to. So initially it's going to be those that know you, know of you, know your track record. It's hard if you don't have a track record to present to get people to invest with you that don't know you. So those would be targets. Also, your former employers, your former coworkers, those are great votes of confidence and references, when other investors are looking. But it doesn't make sense initially to go after like large allocators. Like, great, it's a brand name, they have a big checkbook, but if they're not going to look at you for years or until you're at a different stage, don't waste your time and resources. Know your audience, focus on the early movers, the family offices, high net worth individuals, and also depending on what your capital needs are, you might want to look at seed deals. There's a lot of different seed deals or strategic deals that you could do initially. And then there's, first loss providers. I know they look early too. And then lastly, like your cap intro team, they're a great resource for emerging managers. They've been doing it a long time. They know who the early movers are and could make those introductions for you. So, when you're picking service providers, capital introduction is something to consider, and also not only consider it, but consider ones that work with managers of your size and your stage and, somewhat specialize in that. And you could always add another cap intro team later, another prime broker as you get bigger.
Yes. Thank you, Nicole. Now to piggyback off that, Steve, when you're going out there and you're trying to get money, what are potential allocators looking for when they're coming to do their ODD on you? What would they like to see to make them comfortable that, even though you may not have a 10-year track record, that they're making a solid investment in a company that has solid infrastructure?
Well, let me sort of rephrase that. I apologize. My power strip actually blew up, which is why I was ducked out, and I'm blaming someone who said, "Oh, it's a good thing we don't have power problems today." When we were preparing for this. Look, I'm Steve Kahn. I'm the head of operations for a single family office. And, when we're looking to allocate and looking at, the different funds, especially for us, we tend to like the early investors or the early stage managers. Naturally, we tend to be sticky money, and we, certainly like getting involved from the get-go, especially if a fund has a founders class, which will be open for a certain period of time. Maybe they have, various aspects to the investment structure, like capacity rights and things like that. It really very much depends, on the way that they position themselves. Does that answer your question? Is that what you were sort of looking for?
Yes, that would do it. Yes. So you're so on your end, you're actually looking to give the money, right? And everybody else is looking to get the money.
Yes, I'm the client, which makes
Right.
all the emerging managers, makes me their new best friend.
Yes. Right. So again, so if you're right, that being said, when you're looking at the emerging manager and you go in the old days, let's just call it the old days, an on-site visit pre-COVID, right? What would you be looking for so that a new emerging manager would know to have this stuff set up so that if it was you coming in, you'd already be aware of what you're looking for, they would have it ready, and it would make you comfortable that they're worthy of your money?
Well, number one, there's going to be two components to that. There's going to be the investment thesis discussions that occur in my office, specifically between the investment team and the investment people at the fund. And then after that, should we decide to move forward, that's where I will come in and we will do an ODD. And really all that kicks off with from getting the DDQ and the fund documents, which we're going to look at. And the reality is now, post-COVID, some ODDs still are occurring when we go to the office. Some are virtual, and even the virtual ones, it's a meeting, and then if we want to see the office space, which we always do, we sort of get walked around and get seasick watching the shaky video as we're, seeing how the office is laid out.
Yes. Okay. All right. So, on piggybacking off that one. So, Jeff, once you've cast your wide net and you have this initial pipeline of investors, whether it be 5, 10, 15, 100, how do you determine a more specific targeted subgroup, and for how much?
Sure. So, as an emerging fund, I don't think you can get too picky. Grab as much money as you can. If you are able to secure an anchor, that is extremely helpful. Investors tend to like to follow the crowd. And if you are able to secure an anchor of some significance or of some size, that's always helpful. And sort of harkening back to what Nicole said earlier, I would consider your own sort of limitations and level of sophistication as it relates to the infrastructure that you have in place and the institutional knowledge. Perhaps dealing with a relatively sophisticated investor from the outset doesn't serve your purposes in the most efficient way. As you build that infrastructure, some of those more sophisticated investors make sense. And then finally, I would sort of consider an alignment of interest. If you've got a real niche investor that for some reason is interested in you and that you can't really address, perhaps reconsider going or putting them high on the priority list.
I agree with that. Just to add to that, if you're an emerging manager, emerging managers comes with certain connotations about AUM, right? And, a lot of the big foundations and the pensions and the institutions, have thresholds for, where the AUM needs to be before they can even get involved. Even for us, and we do love, as I mentioned, emerging managers, we're never going to want to be more than 10% of the fund. So, that's going to certainly dictate, the sizing. But, and not to disrespect any, fund of funds, they tend to be less sticky than, say, family office money or friends and family or ultra high net worth. So one of the things that we're going to ask is, who are your investors? Because when we're investing in, say, year one, we want to make sure that the money is going to be, the other money that's in the fund is going to be around.
Right, and I would assume that you also investing in year one, you don't want to own too much of the AUM. You don't want to be too heavy in the allocation.
That's right. We won't be more than 10% ever. And
right.
Look, to put it in perspective, the smallest fund we ever looked at and did something with was $4.2 million.
Okay.
And we invested, with the minimum, which was a little less than 5%.
Okay. Let's see what else.
I'm going to ask some polling questions, Steve, because this is a CPE. So participants who wants to get their CPE certificates has to listen to the conversation for 15 minutes and also need to respond 3 polling questions out of 4th. So our team would put that polling question in a bit. Give us a couple of minutes for that. Or we can wait for a minute.
Actually have something to add to what Jeff said earlier as well. With meeting sophisticated audiences might not be the best, because a lot of times you could meet with a consultant that's going to judge you the same way that they're going to judge a large institution and give you a grade, and that grade is going to stick with you. So, you know, be conscious of that.
Okay, I think we should be back soon from the polling question. Okay.
Oh,
Steve.
we're back. Okay, awesome. I hope everybody got the polling question correct. I know it was hard.
Yes.
Okay. Sorry, trying to keep it a little light. I know it's a long topic, and you know. So my next question, and I guess this will be more, I guess, relegated up Steve's alley first. So if you're an emerging manager and you're casting your net out wide, would you have if you were going to the emerging manager, would you rather see an in-house, you know, would you rather see in-house compliance or outsource compliance, you know, where in-house they could start small and ramp up, or outsourced from the beginning where, you know, you have that oversight from a totally outside third party?
I understand. I get it. You know, look, the reality is emerging managers are emerging, and there is a balance. There is a balance between bringing in the talent to do it in-house and outsourcing. My argument is that either one works, but there's a couple of caveats. If you're very small and you have a GC, a CCO, and a CFO, of course, my question is going to be, are they working for free? Because how can you afford such an infrastructure and staffing, you know, with your AUM so low? So for us, either works. Generally, what we see with an emerging manager is, you know, you have a portfolio manager, maybe an analyst, and then a CFO / CCO. However, you can also outsource that. And for us, that's completely acceptable. I'm going to just, you know, of course, want to know who you've outsourced it to, what kind of oversight, and, you know, have a 20-minute conversation about it. There does come a point where you've grown a little bit and, you know, you could still keep your outsource, but we're going to want to see you hire someone in-house. For example, one of the funds that we had invested in, you know, their assets grew, their performance was good, and ultimately around the $70 million mark, we reached out and said, when are you hiring a CFO? Because it's time. Right. And 6 weeks later, they had a CFO, which made us happy.
Right. And oh, I'm sorry, Steve. Go ahead.
Please.
I was going to throw the caveat in there too, that if they hit the $70 million mark, then they're coming awfully close to having to be fully registered with the SEC, and you would want to see all that stuff anyway.
Exactly right. Exactly right. And you want to, you know, have ideally those people in place prior to registration, just because it will make the transition much more seamless.
Yes. I don't know, does anybody else have anything to add on the in-house versus outsourced?
Yeah, I completely agree with Steve. We like having outsourced early on. If a lot of times we'll meet with a firm and it's 2 or 3 people, and I'd rather them outsource to professionals than do it in-house without the experience. Like somebody has too many roles, but they're not experienced in those roles. Sometimes like the portfolio manager is the compliance officer, and we're like, nope, that has to change. Like you can't be the compliance officer and the portfolio manager. So we encourage it, and also agree with Steve, as you grow and progress, then becomes time to bring that role in-house. But having that professional oversight's great, because that's what these people do every single day. So why not bring the experts in if you don't have the internal capability?
Right. And to your point, Nicole, having a conflict of interest in the roles of the individuals there is going to be a severe red flag.
Yes.
It's a killer. Everyone who's listening,
Yes.
it's a killer, right?
Yes. Steve, I was going to bring up a perfect example of that. So just as some quick little background, I actually worked at a quote unquote RIA where the PM was a part-time COO and the CFO was doing part-time COO work. And they were trying to reel in an institutional investor from overseas, not even from the United States, from overseas. And the first thing that they said was, you guys need to divest yourself from that role and either A, hire somebody in-house to just concentrate on that role, or B, outsource it. Otherwise, you will not get a penny from us. Period. End of story. They wanted to see 100% segregation of those duties.
Right. Like whoever is trading can't also handle the breaks.
Correct. Yes.
Right?
Correct.
Just like, one of the, nuances, and maybe we'll get into the weeds later, the portfolio manager shouldn't be part of the valuation committee, right? It's a conflict of interest. It's sort of like the portfolio manager or the CFO being married to your auditor, right? That's never going to fly.
Absolutely. Absolutely. Okay, so now I'll throw a question out at Jeff. Since he's been quiet for, go ahead.
Sorry to interrupt. Before we ask Jeff, I would like to add this polling question too here and give us a little bit time, a minute or so for the. We're going to close a poll within a few seconds. People will respond. Okay, Steve, go ahead.
Okay, Jeff. So, question for you. So, when you've cast your wide net and you're doing your thing and you're talking to people and people are talking to you, how do they feel when they see that the owners of the fund are actually have some kind of investment in the fund itself?
I think, particularly in the VC space at this point, it's an expectation that anybody that has a piece of the carry is an investor. From our viewpoint, a rule of thumb is anywhere from 1% to 3% of the total fund size. Of course, you don't want a huge amount held by the general partners, because that just sort of demonstrates that there is a lack of interest. But you need for it to be significant enough that they actually have quote unquote skin in the game. For an emerging manager, perhaps you don't have a huge amount of available cash on hand. There are a couple of different ways in which you can sort of structure your capital calls across a period of years as you make your investments. You can defer management fees, but ultimately an investor wants to see that you are committed to what you're doing.
And I guess I'll ask Nicole to follow up, because you're going around and seeing all this when you do your stuff, right? I would assume that it would give an allocator, at least a sense of comfort to see that.
Absolutely. No, definitely managers need to have skin in the game. We always look, and investors, when they're doing diligence, always ask, how much, make sure that they have a high percentage of their liquid net worth in the fund. And it also leads to like personal trading accounts, making sure that you're not investing in other things, that your money is where your mouth is, and it becomes like a whole nother diligence item, which comes to personal trading, making sure you're not in the same securities outside of the fund, that everything, your money is being managed the same way that you're expecting investors to have their money managed as well. So it's very important. And it's more subjective on the hedge fund side than the VC or private equity side, where, like Jeff said, it's about 1 to 3%. On the hedge fund side, it really depends on, how much the manager could put in, because they're likely bankrolling the firm also, and also where they worked before and how much money they made. I mean, it varies, from a few $100,000 to tens of millions. So.
Right.
Very specifically, when I do an ODD, I ask for what percentage of the person's liquid net worth is in the fund. And generally, 50% and up is kind of where we're at, because from our perspective, it is absolutely an alignment of interests. Therefore, both of our assets are at the same risk.
Excellent. Makes perfect sense. Let's see what else. All right. So I guess I'll throw just a basic question out to anybody that wants to raise their hand per se and answer. So obviously the last 2+ years have been tough with the pandemic and doing things virtually and all the other wonderful things that come along with that, the technological challenges and everything else. So have you seen a difference in the way people are allocating or potential investors are even investing into vehicles pre and post pandemic?
I'll start. For us, the answer is no, because we're investing in entities that, regardless of whether they're working from home, whether they're working off the bow of a ship or in an office, it's business as usual.
Yeah, I mean, everyone's expectations change. Post-COVID and the pandemic, you expected the managers all to be in the same office and working together, but now it's acceptable if people have multiple offices, or they're not in, a major city, that they might be somewhere a little bit more remote. It's acceptable now. I'd say way allocators or investors are investing haven't changed, but I think that, from a marketing standpoint, we're not doing as much traveling probably going forward than we did before. I mean, everyone's still going to travel, but a lot of first-time meetings and qualifying meetings can now be done through Zoom or, some kind of other video conferencing service.
And from an ODD perspective, it adds about 5 or 6 questions as to the technological setup for whether they are all in the office or if they're operating remotely.
Right, because I would imagine that, if a substantial part is remote, you would want to know that they have all the right IT infrastructure and firewalls and all that wonderful stuff in place to keep PII safe, right?
Right. And to be able to manage their business effectively, right? And invest effectively.
Correct. I don't know. Jeff, have you seen anything different?
So I would sort of split what we've seen into sort of pre and mid-pandemic versus endemic, if we can call that where we are now. During the pandemic, there was a whole bunch of money sort of around, and perhaps investors were more apt to take some risk. And, at least in the VC space, we saw crazy valuations, a lot of competition for deals. FOMO was creeping into a lot of spaces. And then, as we have come to the end of COVID here, we've seen a lot more discipline. And, folks are sort of pulling back. There's a much greater emphasis on results as opposed to promise. revenue as opposed to potential. So I think we're going to see a thinning of the herd as we move into a period of less than stellar growth.
Okay, awesome. Okay, so let's see, what's another? So getting back to Steve, since you're on the giving side, since you're on the charitable side and you're giving out all the money here, so how much importance do you or a sophisticated investor place on the ability of the fund manager to balance the daily operations and balance controlling the assets of the fund?
It's key critical. I mean, let me just speak to that for a moment. So, as we discussed, there's really two aspects to the investing process for hedge funds. One is the investment thesis side, where the investment guys, the portfolio manager, they're going to get together, they're going to talk about what makes their investment process unique, special, asymmetric, secret ninja sauce that gives them greater rate of returns for whatever that investment strategy is. And if and I'll speak to just my particular firm, if the answer is yes, we think that they have a good investment thesis, they think it's scalable, it could grow, it's repeatable, it'll outperform whatever benchmark they're looking at, then they're going to go to me and say, we want to do an ODD. The reason this is very important for all these emerging managers to understand is that when they come to me and ask me to do an ODD, I'm going to get a DDQ, and we're going to put in a bunch of hours of work looking at how you guys manage the business of managing money. Now, the only reason they're going to ask me to do that is because they are looking to invest. So then I'm going to schedule an ODD, and I'm going to look for reasons not to give you money. And the nice thing about the operational due diligence component is that it's really binary. All of my colleagues, we pretty much ask the same things. We're going to want to know about reconciliations. We're going to want to know about valuation. We're going to want to know about control of cash. Regardless of whether you are doing it in-house or you are outsourcing it, even if you're outsourcing it, there needs to be some control in place and oversight, right, which you're going to need to be able to speak to. So, and here's a secret. If any of you emerging managers have, let's say, 10 ODD meetings, you should be receiving 9 investments. If you're not, if your percentages are less, what it means is during the ODD process, you have a red flag or multiple red flags in the way you're doing things. Because you've already gotten the yes on the investment side. And the only reason that someone like myself is going to say no is because, there were problems, right? Whether it's absurd personal trading policies, which are just not the norm, or there's a problem with the infrastructure, there's a problem with the cash controls, conflicts of interest, the cost ratio of the fund in terms of fund expenses are outside of the basis point parameters that we expect. And the nice thing about when we do our ODD is we approach it from a consultative perspective, because any problems that I see, I'm going to want the fund to fix, because we want to give you money and we want you to be able to manage that money. So some of my colleagues don't like to tell managers what their fatal flaws are. We look at it as an opportunity to consult and end up with a better product after all is said and done.
Right. And Nicole, do you see the same thing when you're going out as well?
Yeah, similar to Steve, if it's a fund that we want to work with and they're just not where they should be institutionally, because we're only going out to institutional investors. So when we bring a fund to an institutional investor, it needs to check every box. So we need to have taken care of everything before we're bringing it, because that's what our investors expect. So that's why a lot of times we'll give them a lot of feedback of things that need to be changed. And there's some things that'll need to be changed before we go to market. There's some things that we say, okay, once you get investor pushback on this, you know you're going to need to change it, because it's not something that's fully needs to be done, but it's a nice to have rather than a need to have at that immediate time. But we spend a lot of time with managers up front doing a lot of diligence and making sure that we can bring them to Steve and that there isn't anything that, you know, comes up. And because it's, you know, reputationally, you don't want to, and no emerging manager should want to go to an institutional investor and fail their ODD.
Right. So that would bring me to my next question, and anybody can chime in, or all of you can chime in. So do you think it's, and again, I'm going to ask the question knowing it may or may not be feasible. I totally understand. But do you think it would benefit an emerging manager to sort of set the standard or their bar from the get-go for an institutional investor, as opposed to a regular, normal run-of-the-mill, 3C1 LP?
Absolutely. I mean, there might be things that they're not doing initially just because of financial resources, but for the most part, definitely structure themselves. I mean, there's certain cyber policies, and maybe hiring, a cyber consultant right away isn't financially feasible, but in time, you need to do it. But everything that you could possibly do to make yourself institutionally from the beginning, you should.
And that's a great point. And even if you can't, right, because of your size or where you're at, you should still be able to speak to me about what your plan is. Right? Like you might say, today we've outsourced the compliance function. However, our plan is that when we get to this level of AUM, we plan to bring that in-house, right? And emerging managers are allowed to have plans, they're allowed to grow, because it shows that they are thinking about being institutional, right? Or they might say, you know what, we're going to add a second PB when we hit this threshold. And at that point, we're going to bring in an allocation system, or this is how we're going to do it. So you don't have to necessarily hit all of the institutional boxes, but you should be able to speak to what your plans are for when you reach that level, if that makes any sense.
Yes. Now, that being said, all that is a great thing to have, and obviously as an emerging manager, most of them will not have. But what they should have is some kind of roadmap to get there. So my question becomes, how many of these emerging managers have you seen where they don't even have the roadmap and it's just totally shut you down from even considering them?
Are you asking me? Oh, I'm sorry. I wasn't sure who you were addressing.
Yeah, the whole panel.
Nicole, after you.
Yeah, I'm sure there's a good amount, and we do meet with managers and we're like, they are just not institutional and they're not ready for prime time yet, and that 100% happens. But use the resources in the industry. Managers, they're used to managing their portfolio. It's their first time, setting up the fund. Use your prime brokers and your service providers. They've been doing it. They can provide you insights. I'm sure you have friends in the industry that have set up funds. Like, use your network to try to learn as much as you can to get you where you need to be. But if you don't want, there's managers that don't want to be institutional. They're happy just managing high net worth client money. And that's where, the market they'll stay in. But if you want to be institutional and you have that, you need to have the roadmap and have thought things through.
Right. And again, it's a finite list, right? It's really relying on your service providers to help you identify everything you need to know is really what emerging managers should be leveraging, in terms of those relationships. And, you know, there are many times where I ask questions and you kind of know right off the bat, because you ask a question like, I might say, you know, what do you do about Rule 105? And then you get that kind of deer in the headlights. I'm like, you don't even know what Rule 105 is. And that's okay because you're an emerging manager. And just for the purposes of this audience, it deals with, you know, you're not allowed to short names that you are then going to participate in the secondary within 5 business days. And, you know, a manager won't know that. And I'll say, look, here's the answer. We don't plan on doing secondaries. However, to look institutional, if we ever did look at, you know, doing a secondary, here is our policy for addressing, you know, Rule 105 under Reg M. Right? So they just have something in place to refer to, even though it may not come up for, you know, 2 years or ever, but just showing that they have that knowledge base and that they understand more than just the particular narrow focus of their current business is what's key critical.
Jeff, anything to add on that?
Not particularly. You know, as an emerging manager ourselves, we've sort of stayed in our lane. And, you know, we know that we are not ready for prime time, right? You know, that being said, we've dialogued with a number of other funds that have attracted institutional money. We know exactly the sort of gulf between where we are and where we need to be, or where we want to be. And, you know, we have a roadmap for putting those markers in place.
Right. So in your case, you've already built out the roadmap. So if somebody came to you, you could just point them to the whiteboard on the wall and say, this is our plan, right?
Exactly. You know, in theory, we know what we need to do, and we just have to put it in practice when and if the time comes.
That's excellent.
I would say that some of the participants are want to ask some questions, and I think there's a section over there under questions. They can go ahead and ask the questions, and we will ask our esteemed panelists to answer their questions. I know it's a time for another polling question, so let's do that now. Give them a minute if they're interested to get the CPE. Okay, we are back, Steve.
When do you want to start the questioning? Because we have about 15 minutes left. How long do you want to leave?
I think we can leave the last five minutes. And they are still trying to figure out how to submit those questions. So I'm just talking.
Okay, that's fine. Okay, so let's see, what else can we ask? All right, so let's see. So for Nicole, you know, I know that you're typically dealing on, you know, with bigger institutional size investors, but if you were to deal with some of the smaller emerging managers, would you like to see almost what I'll call the equivalent of a pitch deck, that would some kind of presentation that would give everybody a simple overview of how they plan on marketing to people, how their investment cycle is going to run, and things of that nature?
Yes, absolutely. So we do work with emerging managers, say late stage emerging managers. So family offices are a large part of our audience, but we work closely with managers on their deck. And I think that's an area that a lot of managers need work on. So often, you know, getting it to look professional is, one step, but go a little bit further and make sure that your differentiation comes through. There's a lot of generic presentations out there. And sometimes with the presentations, even you'll hear the manager speak and you're like, I didn't even know that was going to be your strategy from looking at the presentation. So sometimes the manager is so close to their strategy that they can't convey it in materials. So, think about maybe hiring somebody to help you with that or just talking through it. But, you need to brag, make sure your differentiation, every single manager is going to say they do, long short manager says they do private equity style due diligence, like bring things to life. Like a lot of it also these days is data driven. So don't only say that this is your strength or this is how you do it, show it. Like go through your data, show what your hit rate is, or show how you're making money by sizing positions. It brings it to life. It helps tell your story a lot. So work with your data, make sure that your, pitch book is professional looking. It goes through your strengths, it goes through your process. Don't put too many words on a page. You don't want the investor to be reading during your meeting. You want them to be listening to you. And that kind of brings to another thing where a lot of time we do work a lot on the presentation. So then once we're launching with the manager, we say, we want you to follow your pitch deck in the meeting. And often they're like, no way, I don't do it. I just speak to my strategy. And often when they do that, they don't have control of the meeting anymore. And the investor just keeps asking questions. They wind up going down a rabbit hole and they're not getting across all of the points they want to. And they realize that after the meeting. So by having the pitch deck, you have a framework, you have control of the meeting. You're able to make sure that you touch every point that you want to, make sure that all of your strengths are addressed. And also, throughout that, also another good thing to do is weave in investment examples to really show how your strategy works in real time.
Right. So in a nutshell here, we want to make sure that as the emerging manager, we're in control of the quote unquote interview as opposed to the potential investor getting us off track and us possibly divulging something that we don't want to divulge.
Absolutely. So stay on track and also realize it's a sale. You really are selling yourself too, which managers have to realize that you need to become a closer eventually and brag about yourself in a professional way and make sure that what makes you different has to shine through. Nobody wants another Me Too fund.
Yes. So, and just to add to that, because something interesting happened today, make sure that your marketing materials are accurate and sort of within the industry standard. So an emerging manager, sent me their one-page summary, and it was unclear whether the returns, which were positive, were gross or net. And you should always, number one, in my opinion, you should always be reporting net. And number two, it should say somewhere that your figures are net. So I had to call and ask him that, and they were net. And then I had to call him back because, in the upper little box, it showed, what month to date and year to date and inception to date returns were. But then when I looked at the bottom, the year to date number on the bottom and the year to date number at the top was different. It was like a 10% difference. The top was a 2% year to date return and the bottom was 2.2%. So I'm like, dude, why are your numbers different? I can't give this to my investment committee because you will immediately be tossed in the trash for just not knowing what you're doing.
Right. Not having that second set of eyes take a look at it, making sure that it's professional enough for somebody to take seriously. Nobody's going to take something seriously that hasn't been proofread or even makes sense.
Exactly.
Or sometimes like performer performance and it's not clear and then you're like, oh wait, you just launched, how do you have all this performance? It's not even shaded. You're like, follow the rules, nobody wants surprises.
Right.
Steve, I have heard a few questions, so I would think we should start answering questions if you think you are okay.
Yes,
with
no, absolutely. Everyone, thank you for all your input, and I guess we'll start questions now. Go ahead, Muhammad.
I received this question from one of the attendee of this webinar. He works at some Pershing and Goldman before asking this question. So he's saying, starting with Steve, how much do you ask about other investors in the fund, and how willing is the fund managers willing to share color on that?
Say that again, please.
Saying that how much do you ask about other investors in the fund, and how willing will be the fund manager to answer that?
Well, what we're going to ask very specifically is the number of investors, the type of investors, onshore versus offshore, depending on the structure of the fund. And the reality is this is a standard question, right? And if a fund doesn't want to tell you, we will absolutely run away, because it just means that it could be, one investor. And if I get involved in a fund that only has one other investor that can redeem on me, then I'll be the only investor, which is absolutely not where I want to be. Or if the money is very much concentrated, where if one investor redeems, to liquidate that one investor's sleeve, depending on their percentage ownership, it could have a detrimental effect on the fund. So it's a requirement. So anybody who doesn't believe that, please reconsider your strategy on disclosing such information. We don't want to know who they are, right? Nor should you ever tell who they are. But you could say our breakdown is 22% high net worth individuals, 8% friends and family. The portfolio manager has 50% of his net worth in there, et cetera, et cetera. Give the breakdown.
Yeah.
Thank you. The next question is, and I think probably you and Nicole are the best to answer. How much do you ask about the pedigree of the staff, and how does it weigh in investing into that fund?
So we ask, it's important, but we also are opportunistic. If somebody has been managing the portfolio for a long time, several years, they might not have a traditional background. So we are a bit opportunistic. We're not set to somebody has to have gone to a certain school or worked at a certain place. It's about the repeatability of the strategy and, making sure that it's, an honest, portfolio manager that's trustworthy and, will verify education and, prior employers, but it doesn't have to be a typical pedigree necessarily.
Right, and I agree with Nicole 100%. At the end of the day, pedigree and performance and results don't necessarily have to be one and the same. If Nicole is interested in looking at them, if we're interested in looking at them, it's because they have a strategy that not only is interesting, but it has been successful or potentially successful or has a chance for being successful, depending on how you want to kind of put parameters around those. So the school doesn't matter, background doesn't matter, but we are going to want to see bios on everybody. And then we're going to do our own checks on those backgrounds ourselves.
Thank you. No, it makes perfect sense. Another question is probably, I think Steve is the best to answer, but anyone can chime in. How patient are you maintaining your investment versus expectations on your returns?
I think that from the investment thesis side, that's going to be really strategy related, right? So I know one of the slides talks about, and really the subject of this, is volatility. So if we get involved in a fund that is like a vol 15, we expect the returns to be wild, right? Because that's what you get when you invest in, that kind of fund. If we are looking at more of a, a pairs trading or, low net, where they expect the performance to be, 0.5 to 1.5% per month, up or down per se, that's what we're going to look to see. Now, look, today, a lot of hedge fund managers are kind of getting beaten up. But relative to the index that they're operating in, right? Are they, if their, index is, let's say, down 20%, are they down 22%, 24%, 16%, or are they down 58%? Because at that point, that is where our patients will probably start to wane a little bit. Because then that represents that maybe they're not able to handle volatile markets. But we also enter investments with a long-term thesis. So we are, and this completely doesn't help you at all, but we are relatively patient.
Nicole, would you like to add something?
Yeah, I totally agree with Steve. It really depends on the strategy. When we're taking on funds, that sometimes they're going to be a little bit more volatile, and you're going to get the great returns, but you're also going to have volatility. And right now it's a volatile market. If you successfully get the right investors, they're not going to redeem. Like, we have investors with a volatile fund that are adding money now because they have conviction in the manager. So it's really, really important to get the right investors and make sure that they understand your strategy, that they understand you're not going to get the 70% up if you're not going to be able to tolerate, some kind of down as well. And when you're doing your investors are doing due diligence, let them what a worst case scenario could be, or what your expectation or tolerance on the downside is. To if everyone's expectations are there, you're not going to get the redemptions.
And we're going to ask about what their largest longs are, potentially what their shorts are, because that we're going to be interested in what the drivers are of the performance, and also what the risk is and how that's balanced. Right, that's what we do. That's what everybody does.
Right, and to ensure that you're not concentrated too much in one place.
We might invest in a concentrated manager. That's the strategy. Right? Yeah. 20 longs, 15 shorts, right? 40 longs, 20 shorts, right? That's the strategy that they do. So we know that there's going to be some volatility depending on, the particular names and the sectors. But we made the investment because we believe that the manager can manage that risk and manage that volatility.
And that also goes along with transparency. You're more likely to keep your investors if you're telling Steve or any other investor what you're invested in, so they could evaluate, what you're doing. By being, very not transparent, that's when you'll lose the investors. Right.
And I think, Nicole, you would agree that for everyone that thinks that they are completely unique, there's going to be 10 of you that are completely unique, doing exactly the same thing. And Absolutely. If you don't want to be, investment number one doesn't want to be completely transparent, I suspect that between 2 through 10, one of them will be completely transparent, or transparent enough to meet our needs. Absolutely. Just like, on the operational side, if you're doing something horrifically wrong and you don't want to change, that's okay with me, because I'm going to go to 8 of your peers who are doing it right.
Mm-hmm. And it's so important what you said earlier. Investors are looking for a reason to say no, so don't give them that reason. Try to do all the best practices and norms.
Yeah, just be smart, right? And be on the run. Don't be off the run with some of your policies and procedures.
We have 1 minute left, but I want to ask the polling question, right? So then I would like to ask, let's wait for the votes to count in, then I will ask the final question to Jeff, and we will say thank you to everyone. Awesome. I think it was a great conversation. I really enjoyed. I hope our participants must have enjoyed that. Both Steve did a good job. One moderating, one answering. Seems like they were playing ping pong, and we were having fun.
Yes.
Jeff, I know you raised capital for your VC fund. What would you recommend the new emerging managers who are launching a fund or have launched a fund and and could not able to raise capital, what would you recommend them, the things what you did worked, and you can share your experience being a emerging manager with them.
Sorry, I didn't catch the last part of the question.
Like what things you did which worked, would you like to share with the emerging managers that this is the secret sauce, and these are the best practices I did to raise capital, and they should do at their end to raise capital?
You know what? Honestly, it was just a grind. It's a numbers game, and without any reputation that precedes you, you just have to knock on as many doors as possible, scrape up enough to start building that reputation for yourself, and then hopefully people will start knocking at your door as opposed to the other way around. I don't think that you can take 1, 2, 3 rejections and tuck your tail between your legs. You just have to keep grinding away at it until you build up that pool that sort of sets you up for future success.
Awesome. Steve, from your role being an allocator, what did you think that what the biggest mistakes emerging managers or fund managers do when they reach out to you or you reach out to them that this is no go?
I think that it's really, look, the easiest mistake to fix is not being able to speak to your strategy in, a very easy to understand way. Call it the elevator pitch, to be succinct, to the point, and not go on a 1.5 hour diatribe about, certain quantitative, physics in terms of how you invest. Spending the right amount of money on the infrastructure to support the business, choosing the right vendors, and just being focused on the business and managing the business of managing money.
Awesome. Nicole, I know a lot of emerging managers reach out to you for being a third-party marketer, help them out to raise capital, and obviously you filter a lot of emerging managers before you commit to any of them. What do you think, what you really look into those emerging managers which really stand out for you to say, I think they are the good candidates for you?
Yeah, I mean, it's having an interesting strategy, doing something different, having good performance, of course, being somewhat of a size where we know institutions are going to start looking, and have a well thought out growth plan.
Okay. I mean, I really learned a lot from this conversation. I hope our participants, attendees must learn this. There are a lot of new things for me, even we have been in the industry for a while. I would say thank you to everyone for participating, and we will stay in touch. We will be doing more webinars in the coming days. I think I got another question. Let's see if I can bring that or not. Yes, sorry, I need to.
Nicole, after this, should we fly out to Jeff and do like a due diligence on him?
Okay.
It'll be the quickest fail you've ever received. You've ever been given.
I mean, one of the participants asked for the slide, so we have their email. We will send them the slide. Probably they want to get know one of our info or how to contact. So we will share with them. So I would say again, thank you, everyone. Thanks, Jeff.
Thank you all. Thank you.
Thanks, everybody. It was a pleasure. I appreciate being here.
Thank you.
Thank you.